Hello everyone, thanks for checking out my video. Last week was a roller coaster week for the US stock market. The market whipsawed up and down throughout the week as a series of mixed economic data prompted investors to re-evaluate their view on the US economy. At one point, the S&P 500 clinched its 11th record high for this year, but next moment we saw a sea of red in the market. And at the end of the week, all three major indexes closed lower, breaking their 5-week winning streaks, likely due to the hotter than expected inflation data. So, is inflation coming back to haunt the stock market? And this week we have heavyweight Nvidia reporting their earnings. Their results could give us some insight on whether this AI hype is a bubble or will it continue to boom. Do watch on this video as I discuss more. Alright, it has been a while since we last saw all three major indexes ended a week in the negative zone. But before the market closed red last Friday, investors witnessed a roller coaster week with lots of volatility and whipsaw movements. So what happened was, last Tuesday, the headline CPI data came in hotter than expected at 3.1%, higher than the estimate of 2.9%. And if we were to remove the volatile food and energy prices, the so-called core CPI went up 3.9% from a year ago, which is also higher than the forecast of 3.7%. As a result, the market fell sharply right after the data was released, and Dow Jones posted its biggest single-day decline since March 2023. Well, I would say the decline didn't come as a surprise, but what surprised me was that the pullback lasted only one day, as the stock market shook off the hot inflation report the next 2 days by clawing back majority of the losses. Basically, the so-called buy the dip investors step in to push the market back up again. And then here comes the interesting portion. On Friday, the Producer Price Index, aka PPI, which is a measure of wholesale inflation, jumped 0.3% in January from the previous month. This is higher than the expectation of 0.1%. And guess what? The market had a sell-off again. Anyway, all this hot inflation data actually gave the Federal Reserve more reasons to not cut interest rates so early. It looks like the first rate cut could only come in the second half of the year. And I think the market is adjusting to this expectation with the sell-off last week. For the upcoming week, it will be a holiday shortened trading week as the US stock market closes on Monday in observance of President's Day. The highlight for this week will be none other than Nvidia's earnings, which is set to be released on 21st February, Wednesday. Analysts are expecting a massive more than 400% gain in its earnings per share, aka EPS, as well as a more than 200% rise in their quarterly revenue from around 6 billion last year to 20 billion this year. This would be the third straight quarter of triple-digit gains. But whether Nvidia can meet all these expectations is only one half of the story. The Wall Street will also be focusing on the company's guidance for the rest of the year, because that will give us a sensing on whether the artificial intelligence play can continue their monster run. Alright, given the company's size and its importance to the whole AI boom, Nvidia's earnings will be very pivotal for market sentiment. And I am not kidding you, I do think that any signs of slowing or weakness could slam the entire AI and technology sectors. But of course, if both their results and guidance came even better than the high expectations, the market could really fly. And this is why, according to the current options pricing, investors are betting on the swing of around 11% from the current price level. Again, I must emphasize, this huge swing could happen in either direction. So please exercise caution if you are trading options before the earnings. Hopping over to the technical analysis segment. As usual, let's look at the broader market first by looking at SPY. Well, the chart looks interesting right now. First of all, let's talk about the bearish thesis. As you can see from the chart, for the last 8 trading days, SPY has been moving sideways between these Fibonacci levels of 494 and 503. So what does this mean? It means that after a huge run-up, it is currently in the mini consolidation zone, which also means there is a bit of buyer's exhaustion or profit taking. to also highlight the MACD had a bearish cross as sellers started to step in last week. But honestly, this shouldn't come as a surprise, as I think it's quite common for investors to take profit whenever we hit a landmark level. Right now, it is quite obvious that there is a tug of war between the bulls and the bears at this milestone level of 500, which explains why the stock has been floating around this area for the last 2 weeks. On the downside, watch for 494 as well as the green uptrend channel. If SPY breaks below both levels, I think there is a decent chance for it to go further down to test 480, where the 50 moving average and the all-important 61.8 Fibonacci level converged. On the other hand, if SPY retraces and bounces off that green uptrend channel, that's bullish. In fact, that was what happened towards the end of January. SPY retraced and rebounded off the green line, and that was followed by a surge towards the landmark 500 level. So if SPY can do that again, yeah, it's bullish. That said, SPY may not even retrace to the uptrend channel line. If Nvidia gives us a solid earnings and guidance, we could just bounce off the first support level at 494 and remain above 500 convincingly. If that were to happen, it means that more FOMO buyers will step in to catch the AI rally, and profit takers may stop taking profits to ride another wave up. Just to add, if we can break the recent high of 403 with strong earnings from Nvidia, SPY stands a very high probability to hit 510. Moving over to Apple. Apple's chart looks quite straightforward to me. It's quite obvious that it is bearish at the moment with 6 red candles in the last 8 days. Not just that, it also broke below the all-important 61.8 Fibonacci level, as well as the very strong 200 moving average support. This week, in terms of the downside, pay special attention to 179 to 180 area. This is one area Apple has rebounded on 3 other occasions. In other words, this is a very critical level, and if this breaks, Apple is very bearish. From there, Apple may just go sideways and float around the 170s range, which is a consolidation area where it was at between August and November 2023. At the bottom of this consolidation zone is the low 170s, so don't be surprised if Apple slowly falls to that area. Alright, in terms of the upside, bulls would want to see if Apple can do what it has done in the previous 2 rounds when it fell to the 200 moving average. I have shared this before, but as a recap, Apple has bounced off the 200 moving average 2 out of 2 times it tested this support level ever since it embarked on this monster run that started a year ago in January 2023. To add on, during that 2 occasions, Apple did fall below the 200 moving average a little bit before it bounced up. And right now, Apple is already below the moving average, so give it another 2 to 3 trading days, we should have an answer as to whether Apple's bearish trend can be reversed. If Apple does bounce off the 200 moving average, watch for 183.5. Apple needs to put at least 2 green candles above this 61.8 Fibonacci level to turn the momentum around. From there, we will then have a decent chance to fill the gap at 186. Okay, let's now check out Tesla's chart. Well, in my last video, I mentioned about a bullish MACD cross and the possibility of Tesla climbing to 209 in the near term. That bullish thesis is still intact as Tesla climbed more than 3% last week. To add on, there was another bullish pattern formed on the chart, which I posted on Momo. It's called the bullish inverse head and shoulder pattern. What's even better is that Tesla broke above the neckline, and that's very bullish. For this week, I do think we have a chance to fill that remaining gap between 203 and 206. Resistance should come in either at the end of the gap, which is 206, or that 38.2 Fibonacci level at 209. And if, let's say if somehow Tesla can break above 209, I would say we have a decent chance to fly all the way towards 220, because that's where the next Fibonacci level sits, as well as where the top end of this purple downtrend channel is. Alright, before I move on, I would like to offer a quick shout out to the following viewer who has bought me a cup of coffee via my Ko-Fi link. Thank you for your support. Meanwhile, if you have found my free content useful, you may consider buying me a coffee too, or a YouTube super thanks. If not, do at least help to tap on the like and subscribe buttons, and share my content with your friends as well. Thank you, thank you. Alright, back to business. So, we need to understand that this is Tesla. It gets easily affected by news from Elon Musk, from its price cuts, from interest rates, etc. So if let's say the earlier bullish thesis is wrong, then watch 196 as the first level of support. And if somehow this support breaks, I am not kidding you, Tesla could easily go back to 180s range again. This 180s range, in fact, is an area where Tesla was consolidating for the last 3 weeks, so staying in this area is not a cause of concern for the bulls yet. It is only when Tesla goes below it and breaks the recent low of 175, then yes, bulls should be concerned, because I am of the view that below 180, Tesla may easily slide towards 160s or 150s range. Just to highlight, even when Tesla hit 175 earlier this month, it did not close below 180. It only happened during the intraday trading. Therefore, in short, if Tesla starts closing below 180, it is very, very bearish. Finally, let's have a look at Google's chart. Google is looking bearish. As you can see, it had 3 gap down in less than 1 month. That's quite a rare sight for a mega cap company like Google. What makes it even more bearish is that it broke below the green dotted uptrend channel, went below the critical 61.8 Fibonacci level, and also breached the 50 moving average. And to rub salt to the wound, the RSI hasn't even reached the very oversold level, and MACD also has some allowance to the downside, which means Google still has room to fall. So if the bearish momentum continues this week, I think the recent low of 136 will be tested. Just to share, prior to this month, Google fell to 135 to 136 area at one point, and it rebounded quite quickly. So watch this 135 to 136 area again for a potential bounce. But if we don't get a bounce here, I think we could head towards the low 130s, with the last line of defense at around 131, where the current 200 moving average is. And this is the part that I think I have to highlight to viewers. Since March 2023, Google has never fallen to the 200 moving average at all. In fact, it didn't even go close to this moving average, except for October 2023. So now you know why I say this support is a critical one to watch. On the upside, it's clear cut. Google needs to get above the 50 moving average, above the 61.8 Fibonacci level at 141, and goes back into the uptrend channel. It basically needs to fulfill all these 3 criteria to reverse its bearish momentum. And if Google somehow can make its way to the second gap at 146 to 147, then I think it's almost certain it will push further up to touch 150 before a more meaningful resistance level comes in. Moving over to the options trading section. Last Friday, 16th February, I opened a new cash secure put option on Google with a strike price of 133 expiring 28 March. So now I am going to share with you my thought process behind this trade as well as the risk. So the reason why I saw a cash secure put is that I am of the view that the market had overreacted to the news of a possible competition from OpenAI. Okay, in case you're not aware or you're not updated, OpenAI, which is the creator of ChatGPT, was reported working on a product to rival Google's search engine. It also released its latest AI product called Sora, which can help to create realistic videos from text. When this news came out, Google fell for 2 straight days, dropping more than 3% in the process. I'm not sure if you realize by now that I like to trade based on overreaction in the market. This is why I decided to sell a put contract, which is a slight bullish move, in anticipation of a rebound after the market has digested the negative news. But this is a risky trade because, as explained earlier in the TA section, Google is displaying quite a few bearish signs. In fact, I don't see any bullish signals on the chart at the moment. This means it can continue to fall from this point. Therefore, to manage my risk, I have selected a strike price with a decent support. So, on the shorter time frame, my 133 strike price is one of the Fibonacci levels where the stock could potentially rebound. And on a longer time frame, this 133 level sits on the critical 61.8 Fibonacci retracement level. So combining both, I would call it a double support level. But honestly, if you were to ask me, I would say 131 is a safer strike price to select, as that is where the 200 moving average is. However, the premium was not that great, therefore I selected a higher strike price. But at the end of the day, I must say I don't mind purchasing 100 Google shares at 133. Moving on, so last Friday, I actually had two contracts expiring. The first one is this covered call on Google. For long-term followers of this channel, this trade is not new to you. I have been rolling this option for the longest time, so the strike price for this contract was 125 and was set to expire on 16 February. Quick recap, my cost price for this 100 shares of Google is $100 per share. Google is currently trading above my strike price of 125. Therefore, I could choose to let this contract expire last week, let the 100 shares get caught away and earn a decent profit of $2,500, plus whatever net premiums that I received throughout the multiple rolls. Or I could roll it once again and keep the 100 Google shares. And yep, I did that. And because I don't want to look at this contract so soon again, so I have decided to roll it all the way till July this year, with a new strike price of 130. Come July, if Google stays above 130, the contract will expire worthless and I will earn a profit of $290, less all the trading fees. The calculations are summarized on the screen. On the other hand, if Google stays above my strike price again, I could roll it once again, or choose to let the 100 shares get caught away and earn the difference between the strike price and my cost price, which works out to be $3,000 profits, plus the earlier premium of $290. Okay, the last trade to cover is this cash secure put on Apple, which was sold on 5th January 2024 with a strike price of 170. Back then, Apple was at low 180s, and the reason for making this trade was, once again, I was making use of the overreaction by the market when Apple was hit with two downgrades by Bank of America and Piper Sandler. Ever since I made this trade, Apple didn't go close to my strike price at all. In fact, it always bounced off the 200 moving average, and the lowest it went was 179. As a result, this contract expired worthless and I got to keep the full premium of 180 without having to close the position. For more information about this trade, please click on the link at the top right hand corner and stay subscribed to my channel so that you don't miss any updates. Alright, some end thoughts from me. I will cover two things: inflation and the AI boom or bubble. First of all, inflation. After several months of inflation reports that came in either in line with expectations or cooler than expected, last week's CPI data was one rare occasion where the inflation figures were hotter than expectation. And this latest report was definitely a bad one for investors who are expecting the Fed to cut interest rates soon. But that being said, the overall downward trend of inflation is still encouraging in my opinion. Just like the stock market, inflation doesn't move up or down in one straight line. You will get zigzag movements in all this data. In fact, previously I have shared that getting inflation down from 9% to 3% is easier than pushing it down from 3% to the Fed's target of 2%. The bottom line is that inflation continues to ease and is moving in the right direction. And in my view, just like the stock market again, one day does not define the trend, and therefore one disappointing month does not change the inflation trend. More importantly, I thought the stock market has held up relatively well after some nasty sell-off last Wednesday and a mini sell-off on Friday. In fact, personally, I welcome the latest sell-offs because as I have previously shared, the market was looking for an early and aggressive interest rate cuts, but the Fed has been cautious about it. There was a misalignment in terms of expectations. So with the latest inflation reports, it seems like the market is adjusting their expectations and is more in line with the Fed right now. The current expectations are that the Fed will delay the rate cuts into the second half of the year, and the number of rate cuts for this year should be around 3 times. Next, let's talk about AI hype or boom or bubble. So when investors say that the market is doing well this year, it actually means the tech and AI sectors are doing well, with Nvidia being the core of it. In case you're not aware, whenever there is a massive stock market rally, there tend to be 1 or 2 stocks that are leading it, and this can be a double-edged sword. The positive side of it is that if the leader of the market rally performs well, the rest will likely follow suit. This of course then presents many buying opportunities in other related companies. On the flip side, having a leader or two that drive the psychology of the overall market can also be a negative catalyst, because poor earnings or weakness from them could have a ripple effect on other related companies, in this case all the other AI or big tech companies. Therefore, no matter how FOMO you are right now with AI plays, I do think most investors should constantly look into diversifying their portfolio with positions of companies that are outside of the AI and technology sectors. But okay, I got to be honest, I am not very diversified outside of the tech industry. I mean, long-term viewers of this channel will know that I hold 6 out of the Magnificent 7. And the last time I checked, they made up more than 90% of my portfolio. So if you want to have such portfolio allocation, here's my message to you. You must be able to handle extreme market volatility. Cause back in 2022, my portfolio was down I think more than 30%. But then in 2023, it went up more than 60%. And this year, I am mentally prepared that if for whichever reasons we have some weakness in the demand for AI, I may see a huge chunk of my winnings from the past few months get wiped out, at least on paper. I mean, it's normal for investors to use a less than great performance as an opportunity to take profits, because so much hype has been priced into the stock market right now. So all in all, I think whether you want to focus on the AI hype, it really depends on your risk appetite and your conviction in the various AI stocks. And oh, another thing to highlight, last week's decline in Google's share is a reminder that AI itself is also a double-edged sword, because it is not only an opportunity for growth, but also a threat to many tech companies, even the incumbent tech giants. Okay, in case you missed it, OpenAI was reported working on a web search product to challenge Google's dominance in the search space. And because of that news, we saw Google fell more than 3% in just 2 days. Alright, at the end of the day, yes, AI is the current pillar of growth in the stock market. But at some point, the bubble may burst, the gas tank may go empty, and only some will survive. And I hope you are holding on to those that survive if you are FOMOing into the AI plays and your portfolio is heavily concentrated in the AI sector. Okay, I am saying this to myself as well. Okay, that's all for this video. Don't forget to tap the like and subscribe buttons before you exit, alright? Thank you very much.